What if I told you that owning a short-term rental, an Airbnb, a VRBO, a vacation cabin could generate tax losses that wipe out income from your day job? Not from creative accounting, not from a loophole that's going to get you audited, from a legitimate section of the US tax code. Hi, I'm Aaradh Nagarwal. I'm a CPA, and my goal is simple: to help everyday people understand taxes without fear, confusion, or jargon. Today, we are talking about the short term rental tax strategy, sometimes called the STR loophole, and why it has become one of the most talked about wealth building tools for real estate investors over the last few years. I'm going to walk you through exactly how it works, how to qualify, what the IRS looks for, and how to stack it with cost segregation for maximum impact. To understand why this strategy is powerful, you first need to understand the problem it solves. Under normal IRS rules, rental properties are classified as passive activities. And passive losses, the losses your rental generates, can only be used to offset passive income. Not your W-2 salary, not your business income, only other passive income. So if you own a long-term rental and it generates $20,000 loss on paper after depreciation, which is very common, that loss just sits there. It's suspended. It carries forward until you either have passive income to offset or you sell the property. For high earners, this is especially painful because even the $25,000 passive loss allowance phases out completely above $150,000 in adjusted gross income. The problem in one sentence: long-term rental losses are trapped in the passive bucket and cannot touch your ordinary income, no matter how big they are. Here is what short-term rentals change everything. The IRS has a specific rule. If the average rental period for your property is 7 days or fewer, it is not classified as a rental activity under the passive activity rules. It's treated more like a business, and that distinction is everything. This means the losses from your short term rental after depreciation, mortgage interest, repairs, management fees, supplies are not automatically trapped in the passive bucket. If you materially participate in the activity, those losses become non passive. They can offset your W-2 income, your business income, your investment income, any ordinary income you have. Think about what that means in practice. A physician earning $400,000 a year who owns a short-term rental with $80,000 in paper losses. Losses generated mostly through depreciation could potentially reduce their taxable income to $320,000. That's tens of thousands of dollars in real tax savings. The average state test is only half the equation. The other requirement is material participation. The IRS has 7 tests for material participation, and you only need to meet one of them. The 2 most commonly used for STR owners are these. Test number 1: you spent more than 500 hours working in the activity during the year. For a vacation rental, this means time spent on guest communication, scheduling, cleaning coordination, maintenance, marketing, bookkeeping, all of it counts. 500 hours over a year is about 10 hours a week. Very doable if you are actively managing the property yourself. Test 2: you participated more than anyone else involved in the activity. If you do more hours than your property manager, your spouse, your assistant combined, you qualify. For many hands-on hosts, this is the easiest test to meet. Here is the most critical piece of this entire strategy. You must document your hours. A written log, meaning you track your time as you go, not reconstructed from memory at tax time, is what protects you in an audit. Use a spreadsheet, a time tracking app, a calendar, anything, just keep records. Mistake 1: relying on a property manager for everything. If a management company handles all guest communication, turnover and maintenance and you have minimal involvement, you almost certainly do not materially participate. The STR loophole requires active involvement. If you want a fully passive investment, this strategy is not for you. And that's okay, but know the difference going in. Mistake 2, mixing short and long-term rental periods without tracking carefully. Some owners rent nightly during peak season and then do a month-long rental in the off-season. If your average stay creeps above 7 days across the whole year, you have lost the STR classification. Track your booking every night, every average. Your CPA needs exact numbers. Mistake 3, confusing this with real estate professional status. Real estate professional status is a different designation that requires 750 plus hours in real estate activities and real estate being your primary profession. The STR strategy does not require real estate professional status. That's actually one of its biggest advantages. A surgeon, software engineer, and attorney can use this strategy without qualifying as a real estate professional. These are two separate paths to the same general outcome. If the STR loopholes unlocks the loss, cost segregation is what makes the loss enormous. Normally, residential real estate depreciates over 27.5 years. So a $500,000 property generates about $18,000 in depreciation per year. Useful but not dramatic. A cost segregation study reclassifies components of the property, flooring, appliances, fixtures, landscaping, certain electrical items into 5, 7, or 15-year property. Those components then qualify for bonus depreciation, which under current law allows you to deduct a large portion in year 1. On that same $500,000 property, a cost segregation study might identify $150,000 in accelerated components. If bonus depreciation applies, you could generate $150,000 in losses in year 1 from a property you just bought. Combine that with the STR loophole that makes those losses non-passive, and you have a legal mechanism to generate massive paper losses that offset real earned income. This is why you are hearing about this strategy more and more from high-income professionals. At a 37% tax bracket, $150,000 in deductions is worth $55,500 in actual tax savings in a single year. Here is what to do if you want to pursue this strategy. Step 1, verify your average stay. Pull your booking history and calculate the true average rental period you needed below 7 days. Step 2, audit your own involvement. Are you doing 500 plus hours of work on this property? Are you doing more than anyone else involved? Be honest with yourself. Step 3, start keeping a time log immediately. Step 4, get a CPA who has actually executed this strategy before, not just one who has heard of it. And step 5, if you are acquiring a new property specifically for this strategy, ask about a cost segregation study before you close. This strategy is real, it's legal, it's being used by thousands of investors right now, but it requires discipline, documentation, and the right professional guidance. Done correctly, it's one of the most powerful tools in the real estate tax playbook. Thanks for watching. See you next time. And don't forget to like and subscribe for more tax tips that are legal, practical, and intentional.